When the calendar turned to late 2025, one of the most powerful financial institutions on Earth made a prediction that resonated with millions of investors globally. JP Morgan, a banking giant with over a century of market history, released its forecast for 2026, projecting the S&P 500 index would climb to 7,500 points. This was not a cautious estimate but a bold declaration that the American stock market, even after years of substantial gains, possessed significant runway. For individuals building wealth, families saving for retirement, and new investors entering the market, this figure symbolized substantial opportunity. However, embedded within this optimistic projection were critical warnings and complex lessons that required understanding before committing capital. The forecast represented a compelling narrative of growth driven by specific, powerful forces, but also a map highlighting treacherous terrain that could derail the journey. Decoding the forecast's foundation. To appreciate JP Morgan's assertion, one must first understand the implications of the 7,500 target. From a baseline near 6,760, an 11% annual gain translates to meaningful wealth creation, approximately $1,100 on a $10,000 investment or $5,500 on a $50,000 retirement portfolio. Yet behind this simple percentage lay a deep analytical framework constructed by JP Morgan's global market strategy team led by Dubravko Lakos-Bujas. These analysts were not gamblers but professionals dissecting decades of economic signals. Their work synthesized data from corporate earnings, business investment surveys, Federal Reserve communications, and global trade flows. The forecast emerged from conference rooms where strategists debated the interplay between interest rates, productivity, and corporate profits late into the night. Their conclusion rested on two core pillars. First, that S&P 500 company earnings would grow at an above-trend rate of 13 to 15% from 2025 through 2026. And second, that the Federal Reserve would manage a soft landing, cutting interest rates modestly by half a percentage point to sustain economic expansion without reigniting inflation. This delicate balance was the essential precondition for their bullish outlook. The unstoppable engine, artificial intelligence. The primary force propelling JP Morgan's optimistic scenario was the ongoing revolution in artificial intelligence. The bank's research identified an acceleration, not a plateau, in AI investment. Spending on the massive data centers required to train and run advanced AI models was projected to surge by roughly 50% in 2026, following an already historic 65% increase in 2025. This represented a tidal wave of capital expenditure from technology leaders like Microsoft, Amazon, Google, and Meta, each deploying tens of billions of dollars. This spending created a powerful economic multiplier effect, generating high-skilled jobs for engineers and technicians, while driving unprecedented demand for semiconductors, advanced networking equipment, cooling systems, and electrical infrastructure. The AI boom was therefore not confined to software companies. It was triggering a capital investment cycle reminiscent of earlier industrial revolutions, with ripple effects benefiting construction, manufacturing, and utilities. JP Morgan's analysts viewed AI not merely as a technological trend, but as the dominant macroeconomic driver of the era, capable of boosting overall productivity and corporate profitability. The K-shaped market and its winners. This AI-driven growth, however, was creating a profound and potentially persistent divergence in the market, a K-shaped economy. On the ascending arm of the K were the clear beneficiaries, companies directly involved in creating or deploying AI. This elite group included semiconductor designers like Nvidia and Broadcom, cloud computing providers building out data center capacity, software firms integrating AI into their platforms, and networking companies like Arista Networks that connect these vast digital systems. Their profit growth was exceptional, and their stock prices reflected this supremacy. On the descending arm were companies being left behind. This encompassed traditional retailers struggling with e-commerce competition, manufacturers and slow growth cycles, and service businesses unable to leverage new technologies to improve efficiency. The distance between these two groups was widening, and JP Morgan warned this divide would likely intensify in 2026. Success for investors would depend critically on sector and stock selection, emphasizing exposure to the right side of the economy. The era of broad, indiscriminate market rallies was giving way to a period defined by stark winners and laggards. Specific recommendations and sectoral opportunities. JP Morgan supported its thesis with explicit investment recommendations, providing a practical roadmap. At the forefront were AI-centric firms. Alphabet, praised for its Gemini AI model and cloud business with a price target of $385 per share. Broadcom, highlighted for its custom AI chip designs and projected AI revenue of $55 to $60 billion in 2026. And critical infrastructure suppliers like Arista Networks, Marvell Technology, analog devices, and Micron technology. Importantly, the bank's vision extended beyond pure-play technology. It identified secondary beneficiaries across the economy, arguing the AI revolution would create a rising tide for many sectors. Financial firms, for instance, were beginning to use AI for risk assessment and operational efficiency, with companies like Allstate cited for using AI to refine insurance pricing. The industrial sector was poised to benefit from the physical build-out of data centers and power grids. Materials companies supplying copper and aluminum for this infrastructure would see elevated demand. Even utility stocks, often considered defensive, were recast as growth plays due to the insatiable electricity demands of AI data centers. This analysis urged investors to think holistically about the AI value chain, recognizing opportunities in often overlooked old economy stocks. The critical role of the Federal Reserve and defined risks. No market forecast is complete without addressing the Federal Reserve. JP Morgan's model assumed the Fed would execute a delicate balancing act, cutting rates by 0.50% to support a softening labor market, while accepting inflation that remained slightly above its 2% target. This dovish tilt was crucial for lowering borrowing costs and sustaining the investment boom. However, the analysts meticulously outlined the substantial risks that could invalidate their forecast. They assigned a 35% probability of a U.S. recession in 2026, which would severely depress earnings and stock prices. Stubborn inflation presented another major threat, potentially forcing the Fed to maintain restrictive rates. Geopolitical shocks, such as an escalation of trade tensions or conflict, could disrupt global supply chains and spike energy prices. Lastly, they acknowledged the risk of AI disappointment. If the technology's promised productivity gains failed to materialize as expected, the historic investment cycle could stall, leading to a painful revaluation of the market's leading stocks. This clear-eyed risk assessment was integral to the forecast's credibility, distinguishing it from unfounded optimism. The bull case, a path to 8,000. Beyond their base case, JP Morgan outlined a bullish scenario where the S&P 500 could surpass 8,000 points. This would require a Goldilocks alignment, the Federal Reserve cutting rates more aggressively due to a faster decline in inflation, AI delivering productivity gains exceeding current lofty expectations, potentially boosting worker output by 30%, and the economy avoiding recession entirely. In this ideal world, surging profits and lower discount rates would combine to propel valuations higher. While presented as a possibility, this scenario was framed as a low-probability outcome requiring near-perfect conditions, a reminder of what was possible but not what was probable. Historical context and structural warnings. Placing the forecast in context, an 11% annual return aligns with the S&P 500's long-term historical average. However, recent years have been atypical, featuring a strong post-pandemic rally. This created a debate. Were markets due for a mean-reverting pullback, or was AI creating a new paradigm akin to the 1990s internet boom? History offered cautionary tales of bubbles, but also examples of sustained bull markets during genuine technological transformations. JP Morgan highlighted two deep structural concerns. First was extreme market concentration, where a handful of mega-cap tech stocks drove a disproportionate share of index returns. This concentration, likely to increase with AI dominance, created systemic risk should those leaders falter. Second was a puzzling K-shaped labor market. Robust demand and wages for AI-skilled workers contrasted with softness in broader hiring. If this trend persisted, it could weaken consumer spending, the bedrock of the U.S. economy, and undermine the growth needed to justify market valuations. The global and commodity landscape. JP Morgan's outlook had a global dimension as well, forecasting double-digit gains for international equities as well. Specific opportunities were noted in Europe from German fiscal stimulus and Japan from corporate reforms, though currency fluctuations posed challenges. In emerging markets, countries like India and Brazil could benefit if U.S. rate cuts spurred capital flows towards higher growth regions. The commodity forecast painted a nuanced picture. Oil was projected to average a moderate $58 per barrel, aiding consumers but pressuring energy stocks. In stark contrast, gold was forecast to soar to $5,000 an ounce, driven by central bank buying and its role as a geopolitical hedge, a clear recommendation for portfolio diversification. Natural gas prices were expected to fall, providing a cost tailwind for many industries. These projections supported the thesis of contained inflationary pressures. Practical guidance for the regular investor. For the average person, JP Morgan distilled its analysis into actionable, timeless principles. Stay invested. Historically, long-term equity exposure has outperformed cash and bonds. Timing the market is exceedingly difficult. Diversify strategically. Avoid over-concentration in a single hot AI stock. Spread investments across sectors, technology, financials, industrials, healthcare, and geographies to mitigate specific risks. Focus on quality. In a potentially volatile environment, prioritize companies with strong balance sheets, consistent earnings, and durable competitive advantages. Think long-term. Tune out daily market noise and media hype. Successful wealth building is a marathon of discipline, not a sprint of speculation. Rebalance periodically. Systematically trim winners and add to underperformers to maintain your target asset allocation and lock in gains. The psychological dimension was emphasized as paramount. The ability to resist fear during sell-offs and greed during frenzied rallies often determines investor success more than picking the perfect stock. Areas of caution and the unknowable future. The forecast was explicit about where not to invest. Traditional retail, troubled commercial real estate, especially office space, highly indebted companies, and small-cap stocks lacking resources to compete in the AI era were flagged as vulnerable sectors. This guidance was as crucial as the buy recommendations. Finally, JP Morgan acknowledged the humbling truth that the most market-moving events are inherently unpredictable. Breakthroughs in quantum computing, energy storage, or biotechnology could emerge from labs and garages, creating new winners and obsolescing others overnight. A good forecast prepares investors for visible trends, but wisdom lies in maintaining humility before the unknown. The journey forward. JP Morgan's 7500 forecast was ultimately a story about navigating uncertainty with analysis and discipline. It provided a coherent narrative for a market at a historical inflection point, shaped by AI, geopolitical shift, and demographic change. The precise year-end number was less important than the framework it offered. The path forward would be volatile, marked by setbacks and surprises, yet for the patient investor adhering to principles of diversification, quality, and long-term focus, the forecast reinforced a fundamental belief in the progress of human enterprise and innovation. The journey to financial security is not about chasing a single number, but about building a resilient portfolio and mindset capable of weathering storms and capturing growth over decades. In that pursuit, JP Morgan's 2026 forecast served not as a promise, but as a detailed map and a compass for the road ahead.